you're in this very short-term period here where we're cycling through the tariff announcement from a year ago, where it feels like we've got higher year-over-year economic growth, but we would expect that to turn back to a growth deceleration within a couple of months, and you're back to this sort of stagflationary type environment for the next couple of quarters.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. Welcoming you here for a conversation with Oxbow Advisors Chief Investment Officer, Chance Finucane. Oxbow Advisors is a high net worth advisory firm founded by Ted Oakley, who you've seen me interview a lot in this channel, that specializes in servicing high net worth clients. But we'd like to get Ted and his cohort there, Chance, on this program as often as we can. Chance, thanks so much for taking your time, taking time out of what I know is a very busy period to come talk to our viewers here.
Yeah, it's always great to talk to you, Adam.
Well, thanks, Chance. All right. Well, look, it's not like there's much going on in the world to talk about, huh?
No, not at all. And yet it's interesting, like we're talking on Monday morning here, and there's not even that much movement in the market anymore when there's big geopolitical news happening over the weekend. So it seems like markets are pretty used to this over the past month and a half.
Well, yeah, so I was being facetious, but that last point is actually pretty accurate, where I think we're seeing the volatility of the market's reaction to all the different back and forth going on here with the Iran war. I don't know if it's just exhaustion or if it's the market's confidence that we're getting closer to a predicted outcome that is reducing that volatility. And now, on the day we're talking, going into this past, so it's a Monday, as you said, on Friday going into this weekend. Iran had declared that the Strait of Hormuz was open, totally, completely open, I think was their words. A lot of positive tweets from the president or truth socials from the president saying this thing is pretty much wrapped up. Then, of course, everything changed over the weekend, which ended up with the Iranian, I don't want to say the Navy, but some of their ships firing on some, I think, Indian ships, closing the strait, and then the U.S. Stopped and boarded a Iranian vessel. So obviously, things are escalated. This is while the envoys from both countries are going back to negotiate a second round in Pakistan. Still a little unclarity as of the time we're talking whether the Iranians are even going to show up for that or not. So, I mean, there is a lot of continued uncertainty here, but the markets, as of Friday, we're at all-time highs. They're off not that much today, given all the uncertainty here. Oil has come down pretty substantially from its high, still elevated, but only up about 5% today, which would normally be a big move in the oil markets, but not nearly as much as how oil has reacted on certain days over the past couple of weeks here. So I guess let me ask this question, and then I'll zoom up to an even higher level. But in your opinion, Chance, does it seem that the market is pricing in a relatively near conclusion to this conflict in Iran, one way or the other?
I think you're right. I think it's pricing it maybe, I don't know if they know the exact timeline, but they want to look out far enough to where a ceasefire or some sort of peaceful agreement or some sort of conclusion is reached, whether that's 3 months from now, 6 months, 12 months, and just want to assume that we get back to normal, whatever investors believe normal is, and just want to start investing from that standpoint rather than trying to price in these events that are happening in the interim.
Mm-hmm. And an important tell, I think, on this is the oil futures market. You don't have to go out that many months before there's really not much of a premium to oil at all versus pre-war, correct? Meaning the oil market doesn't believe that these higher oil prices are going to last for that much longer right now.
That's correct. I think especially when you get out by the end of the year, that premium starts to recede quite a bit. And there's still a lot of variability in terms of what an actual barrel of oil is selling for in different parts of the world and
Sure.
different types of crude that you're trying to transact. But yeah, I think the assumption right now in the futures market is once you get out to December, things look a little bit more like they used to be.
Okay. And of course, in this conversation, Chance, we'll get to how you and Ted and the team at Oxbow are positioning client capital given the confusion, the market optimism, yet some very valid reasons for concern but we're going to work our way to that. Okay, zooming up to a very high level, I'm going to ask a question. I don't ask that much more these days, but I think it's helpful to ask you here at this time. What's your current assessment of the economy and the markets right now, Chance? Um, I've got some questions to ask, but I don't want to lead your answer. So
Sure.
just to that very general question, what's your succinct answer?
So if we're looking at it today, I think the first thing we believe is that this acceleration in the inflation rate that we just experienced in the past month and is likely to come through in the next inflation reading we get in the CPI, we expect that higher inflation to continue through the rest of the year unless the oil price really breaks back down to where it was a month or two ago. But I think higher inflation, and then you're in this very short-term period here where we're cycling through the tariff announcement from a year ago, where it feels like we've got higher year-over-year economic growth, but we would expect that to turn back to a growth deceleration within a couple of months, and you're back to this sort of stagflationary type environment for the next couple of quarters that just increases the variability of what could happen. And that's where we're positioned right now is trying to stay flexible, take advantage when there's a distortion or a significant move like we had to some extent in March. But then when things go back to being priced as if everything's going to be okay like they are today, our activity in our portfolios goes back down to a pretty normal level just because there's less to do. There's less distortion in asset pricing.
Okay. Let me ask you this. It's going to be tough, but just imagine for a moment this war hadn't happened. Coming into this year, the administration was telling us to expect economic growth to really start ramping up. And from folks that I have interviewed recently, there are parts of the economy you can point to say, hey, yeah, that's beginning to happen there, right? And we did in fact get these large tax refunds that the administration was telling us to expect. Now, a lot of that might have, is going to pay for these higher oil prices, but it doesn't seem that all of it is. It seems like on a net basis, net spending is still positive here. So if the war hadn't happened, I'm just curious, what was Oxbow's expectation for economic growth this year? Were you bullish, middle of the road, or bearish?
Probably middle of the road. Although I think Ted has been consistent since the beginning of the year that these midterm election years tend to be pretty choppy. And whether
Hmm.
that's just sentiment in the market getting too extreme in either direction or certain events happening or being priced in, such as the possibility of the Democrats taking back one or both parts of the House. Things like that of that nature could create some volatility that just you want to keep on your toes and make sure that you've still stayed nimble in your portfolios. So I actually was thinking back to in mid-February, Ted did an interview where no one had any idea that any of these events in the Middle East were going to happen starting 2 weeks later. And just listening to that conversation to him in March after things had started is just interesting almost as a time capsule to see that we
Yeah.
were saying that prices were high. We like what we own, but we're not getting ahead of ourselves. It seems like at that time, you still had the AI trade. Everyone was really bullish about that, which has returned again. But you had all these old economy sectors that everybody was racing into as well. And we've seen that come back down a little bit in spaces like industrials, consumer staples, materials, sectors of that nature. And that was where we took advantage somewhat in March, where you kind of try to play the prices that are available to you. But if that had not happened in March, where we never had a conflict in Iran, we might just have seen a continuation of that until something else would have created some alarm in the markets.
Okay, and I just want to dig into this a little bit more. And again, I want to really parse the difference between the economy and the markets. We've gotten so used to them trading in the same direction, but they don't have to, right? And there are periods in time where they haven't. Um, and Ted is right. The midterm election years tend to be pretty poor years from a market standpoint because of all that uncertainty. Um, but from an economic standpoint, and I guess where I was trying to get at was, did you guys have a default thesis coming into this year before the war of like decelerating growth or recession, or were you predicting growth to be moderate to high?
Probably just moderate. I don't think we expected an acceleration. I don't think we were predicting a recession either. I think it was more just be on your toes, watch things closely because you just weren't sure what was going to happen. But that kind of like 1.5, 2% real GDP growth is probably about the base case. And then you just watch closely over the course of the year to see if anything really pushes that in one direction or the other.
Okay, so moderate growth default assumption pre-war. Okay, now we have the war. And we have this oil price shock, which is creating an inflation, a surge in inflation. What does that do to your economic outlook?
That would depend on how long the oil price shock or the price stays very elevated.
Yeah,
If you have,
give me two options then. War
yeah,
ends quickly, war continues for 6 more months.
yeah, if the war ends quickly and oil goes back down to this sort of like 65 to $80 range, it's less impactful to the overall economy. It doesn't hurt consumers' wallets as much as you were mentioning. It doesn't offset that whole tax break that everyone's hopefully receiving. But if oil was getting up to $120 a barrel and stayed there, and people have talked about if the Strait of Hormuz stayed closed for 4 to 6 weeks or longer and truly stayed closed, that would be really impactful because there's just no way to try to reorient where all the movement of oil goes in other parts of the world. There would have to be demand destruction, which then impacts economic growth around the world. It would kind of have a cascading effect. That's where you would see more of a true risk of recession. But if there's going to be some sort of short-term ceasefire or some sort of agreement that allows the oil price to stay in check, then it's more difficult to see a true recession kicking in the near term.
Okay, I think most people are in agreement with you that, hey, if this war is prolonged, yeah, it just economic slowdown slash global recession kind of baked in the cake. I think that the disagreement right now is if it ends relatively soon, how much damage has been done, right? Some people are saying, hey, there's still going to be a shock. We're going to have to pay a certain price. Maybe Q2, looks pretty ugly as a result. Um, Obviously some other countries are getting hit more than America. And while America is more resilient economically, still those countries spend money here. And if they spend less, that affects our growth. So I guess my question is it something you think we just shrug off and it's kind of not a big deal, almost a nothing burger, or is it more substantial than that? Again, were the war to end soon?
If it ended soon, I think consumers can muddle through and find a way to make things work. And that's where I think you're trying to make the distortion or the distinction rather between the economy and economic growth versus markets.
Hmm.
And whereas we're trying to have a good sense as best we can of what's happening in the economy, it's as much what pricing we're getting certain types of businesses and what we're trying to do for our clients' portfolios that we're really trying to get correct. And so I think not knowing just how much damage could be done to the consumer. For one example, we added or bought a few new consumer-based stocks in March, but we weren't going out and buying a company that manufactures boats or something that's like a major consumer purchase that has these wide cyclical swings.
Like the luxury purchases, yeah, the non-essential,
Yeah.
yeah,
We're
discretionary.
buying Ulta Beauty or Gildan Activewear, or we just our latest buy last week in the stock portfolio was Hershey. Really simple businesses with very consistent cash flow that we got better prices in that we think can grow at a moderate to good rate over a period of time, generate a good return. But it's not really a case where you're trying to swing for the fences because there's been so much damage to the consumer that the prices have fallen a lot and you can really buy in at a low. So you're kind of trying to look at it from that standpoint.
Okay. And okay, so but basically what I hear you say is sort of muddle through this. It's not um, you're not expecting a ton of carnage economically if the war were to end soon, at least in the U.S. From a market standpoint, like we said, the markets, as of close Friday, all-time highs, with a ferocious momentum from the low, right? I think it was something like the most vicious V recovery in the S&P since like the early 80s or something. I think I read that stat somewhere. Um, how much more, well, I guess, what would you expect the markets to do if a peace deal is reached pretty quickly? Would that be a sell the news event? It's all been bought on the rumor, or would this be the resumption of a continued uptrend in the market from then on? It'd be kind of like an all clear to Wall Street.
People would probably take it as an all clear in the near term. What's most interesting from this rally since March 30th and Mike Green actually just wrote this in a note on his Substack that I think came out yesterday that I thought was a great way to concisely put it. Uh, People have come back into the market. It's risk on, but not specific risk on. And
Hmm.
so you mentioned the stat. I saw the same thing that for a 5 to 10% correction in the market, this was the fastest retracement in 100 years for how quickly you got back to the previous all-time high. So what's driving that though is really seven stocks have been 60% of that return in the last, call it 3 weeks. It's
Hmm.
six of the Magnificent Seven minus Tesla, and then you add in Broadcom. And then
Hmm.
another way you can look at it is that almost half of the return has just come from the semiconductor industry, which is only
Yeah.
about 15% of the market, but is up 30% in 3 weeks.
I
So,
think that's a good point. Sorry, no, I think it's a good point, but I mean, is that any different than what's driven the market action in the past 3 years? It seems to have always been kind of going where those seven stocks were going.
but that's the difference is the first 2 months of this year, it was AI, but it was also all of those old economy sectors.
Right.
So
We had a brief moment where the value stocks, there was rotation from growth to value. I guess he's saying, well, we're back to the old story. It's back to hyper growth only.
yeah, well, it's twofold. So what we notice is while the S&P 500, the market cap weighted index, is back to all-time highs, it's almost 4% above where it was trading at the end of February before all this happened. The equal weighted S&P
Hmm.
500 has not gotten back to its highs. And if you look at those old economy sectors, they have not gotten back to their previous highs of a couple of months ago. So that's the difference in terms of what investors are doing right now is they're getting back into the market broadly or back into that AI trade, but they have not jumped back into the other sectors that were driving that return the first 2 months of the year. So that's what we're watching is this rally going to broaden out? Or is this just everyone trying to say, oh, we don't want to get caught off sides. We need to get back into stocks again, but we're just going to go back into the safest secular growth play possible and just try to hide there and capture the return that way.
Right, right. And as you say, we may be too early to make the call. I'm just thinking maybe another way to say it is if we get the all clear here with some sort of peace deal, is Wall Street just going to go back to the playbook that it's been running for the past 3 years? They took a little break from it coming into this year, but are they just going to go back because, hey, that's just what's worked for the long haul, and I'm just going to keep doing it?
Yeah, and I think you're right. I think they already have gone back to that playbook for AI.
Hmm.
I'm curious to see if they go back to the playbook on the old economy sectors that they were playing in the first 2 months that led to those sectors really being overpriced. And then those pulled back significantly, which allowed us an opportunity to buy some of those positions. And they're still trading at fair enough valuations. But if those go back to being overpriced, then I would say there's really nowhere new to go in the market. You're just kind of priced in all the optimism that could happen, and you're just waiting for the next event that could make everybody scared it leads to another correction.
Okay. And I know that Oxbow, for a good long while, has been concerned about valuations. As I've talked about with a number of experts on this channel for the past couple of years, valuations have been stretched to near, or in many cases, all-time levels. And we're kind of getting back in that direction here. Um, so, time will tell. All right, I want to ask how you guys are positioning right now at Oxbow because it is tough, right? Markets become optimistic again all of a sudden. You want to play the market, doing whatever the market's doing. But in addition to just sort of secular concerns like the valuations, you don't know if we're going to get a peace deal or not. You don't know if the market is pricing in a happy ending that's actually not going to materialize, right? So you gotta hedge whatever bets you're doing here. Um, all right, well let's just go there. So how are you kind of navigating that uncertain chasm right now?
Sure. Our cash position is pretty similar to what it was to start the year in the different strategies. So in the stock portfolio, we're still sitting with about 40% in short-term treasuries, about 60% in stocks. In high income, it's more along the lines of about 40% invested in various equities, typically more exposure to commodities in those equities in the high income portfolio. And then the remainder is in fixed income, primarily short-term treasuries, and then some investment grade corporate bonds that mature in less than 5 years, typically about 3 years on that front. And then our conservative portfolio continues to be focused on short-term treasuries and municipal bonds with a little bit of an allocation to gold. So it hasn't changed that much, but one thing I would stress is that there are constant incremental adjustments that you're making that don't feel like much from day to day or week to week. But I was just doing this with the rest of our team, looking at where the high income strategy was positioned in January versus where it's positioned today.
Hmm.
And you actually see a significant amount of movement where when you saw yields jump up, we actually added a little bit to our corporate bonds exposure. That's more like 10% of the portfolio now rather than 6. We actually cut out all of our silver exposure. We had reduced it significantly towards the end of last year and in January of this year, but at this time we've just taken it out completely. In the meantime, we've kind of really retrenched on gold, but made sure that everybody's got about a 5% exposure to gold and a few gold companies. And then trying to find exposure into other parts of the commodity market, whether it's in agriculture or in other metals and mining, some rare earth metals. Like Ted found a company called Almonte Industries that is a tungsten miner, which is a key mineral used for defense industry, which there's going to be a lot of new defense equipment being produced in the years to come. And 80% of tungsten in the world is sourced from China. So for all these governments and companies that need tungsten for their materials that do not want to just be dependent on China, a business like that is going to be valuable in the years to come. So you're trying to find avenues like that to be able to see where things are headed broadly in the years to come, and not being so focused on trying to figure out what's going to be the best play in the next 1 to 3 months, which I think in geopolitical events that are so acute that's happening like right now, it's common to think about what's happening, what could happen in the next few weeks when really
Hmm.
you're putting in the framework of where are we headed in the next 3 to 5 years, and where do you want to be positioned?
Okay, so that's what I was going to ask. So, uh, both you and Ted in your previous appearances on this channel in the past year have said, "Hey, we're not really doing the 60/40 allocation. We're doing what we call the 30/30/10, and that sorry, the 30/30/30/10, and that 10%, if I'm remembering correctly, that's is that 10% more the commodities and hard assets, or is that one of the 30s?"
The 10 is more just distinct special opportunities you find. It can be kept in more cash, and then you take advantage of special
Okay,
situations.
so that's opportunistic. So one of
Yeah.
the 30s is the commodities, right?
Yeah, and that's pretty right. I think it's actually a little above 30% of the high income portfolio that is focused on commodity exposed businesses. And it's a combination of crude oil, gas, gold, a little bit of uranium and coal, and then agriculture and other metals and mining.
Okay. So when you were talking about how, I'm going to ask you about how you're lightening up on the precious metals in a second, but when you said you're increasing your exposure to other types of commodities, um, is that just sort of in pursuit of that 30 part of your strategy, or how much of it, if any, is related to the war and the fact that global supply chains are getting pinched now because the crimping of oil flows?
I think that's partly true, and I think that's it's a good. I'm glad you brought that up. Instead of trying to figure out how the war ends or where this ends up, whether it's in the next 1 to 3 months or later this year, uh, thinking about it from a broader standpoint of uh, where are the supply lines more likely to be cut or just not as reliable? And what does that do to businesses and governments that need those supplies? One, they're going to need more a resilient supply chain, so they're going to want to stockpile more. Two, they might look for other avenues to be able to source things from rather than from a specific region of the world where there might be more conflicts to come in the future. So that was one reason for the agriculture focus is how much of those inputs are those materials are coming through the Strait of Hormuz, and with less supply, you're going to see prices increase, and that might be an off and on thing for years to come if that conflict lingers for longer. And then this desire for building up more equipment, things like that, in an area like defense. These rare earth minerals are going to become more valuable. And when you actually do the research, you see just how high a percentage are being sourced from China.
Hmm.
And so there's going to be a need for other sources in other parts of the world and companies that are in more friendly jurisdictions, like in the US or other parts of North America, it's going to be valuable.
Okay. So correct me if it's wrong, this is wrong, but it sounds like this was an area that you appreciated so much so that you created a 30% allocation for it. But you are you're leaning into it even more actively given what you think the knock-on effects are currently coming from the war.
I'd
All
say
right. Yeah, good.
I would say it's been an ongoing effort for several years, and I think what we've noticed over time is that our exposure across the commodity spectrum is broadening. Whereas, say, 8 months ago, nearly half of that 30% exposure might have been precious metals, and then you
Hmm.
saw just how much investor interest drove those prices to pretty high levels. That led us to incrementally take some off the table and reallocate to other areas, and just trying to make sure that we have as good of exposure across the whole commodity space as possible.
Okay. So I'll ask you about gold in a second, but let me just start with silver because you said you pretty much totally out of silver at this point. Now, silver went bananas as we tracked closely on this program, and I do feel pretty good about telling people, once it zoomed across $100 an ounce, I said, folks, this is getting too good. Don't get used to this. These vertical moves don't last, and there's a chance of a pullback is pretty likely at this point. That did manifest. So I can totally understand why Oxbow lightened up coming into this year on silver. Why did Oxbow decide afterwards to just get out?
Yeah, we've sold most of it already, so it was already down to maybe only 1% of the portfolio. I think Ted, just in his analysis, just to make a distinction between gold's always most of the exposure for us in precious metals
Hmm.
in a normal environment. That's really the focus. Silver is the more speculative asset within that industry. So we try to take advantage when we think there's an upward swing coming in prices for precious metals broadly. But if we're in this current period that's going to be a bit choppier, you could easily make a case that silver might retrace that decline and go back down to $60 or even into the 50s from where it's trading today at about 80. We just don't, we can always buy it back later. We're not as focused on making sure that we've always got a certain amount exposed to silver, the same way that we are always sure that we've got our clients with a certain amount of exposure to gold and gold related equities.
Okay, gonna get to gold in 1 second. What would you want to see with silver to say, all right, time to add it back in?
It really just comes down to price and just seeing some more investor capitulation. Right now, you're in this really strong short-term rally where it's been almost like a one-to-one correlation where US dollar weakening, precious metals like
Yep.
gold going up, even Bitcoin going up, certain other types of equities, growth equities going up. That can easily retrace some of that rally here in the last few weeks. And then we might get an opportunity to add silver back. But more likely, I would say we'd end up adding a little bit to our gold and gold related exposure. That would probably be the first priority, is if we saw gold pull back towards 4,000 from the current level of about 4,800. I think that would be one that we'd be even more inclined to make sure that we've got our positioning set for what could be a further move in the intermediate term over the next couple of years towards an even higher level.
Okay. And I'm going to pull up some slides here from Oxbow's recent Q2 quarterly outlook. You guys put a video out a few days ago on this. And the section on gold started with this slide here about the US national debt. No surprise to anybody who watches this channel that the debt is high and growing quickly. But Ted was keen to point out the speed of the increase is just accelerating. And that's what happens in exponential systems like our fiat money system and the resulting debt increase. But you note here that we added 3.6 trillion of debt, a 10% increase in only a year and a half. And one of the knock-on effects of that is that the world is starting to really look for ways to protect itself from the debasement of fiat currency and most notably the US dollar, right? This was the debasement trade we heard all about second half of last year. And we can see here that gold is now passing US treasuries in foreign reserves. So you can see the two curves here. Now, one thing to note, correct me if this is wrong, Chance, I don't believe this is ounces of gold per se, even though central banks are net buyers. This is the market value of the gold as the gold price has been rising. So you've sort of had two factors here that are pushing that light blue line above the treasury line, is that they're buying more ounces, but those ounces are becoming more valuable. Did I summarize it correctly?
Yeah, yeah, I think that's right. Is that the market value for gold is essentially doubled over this shorter period of time, and that's helped
Right.
as their net buyers.
Right. But the reality is just on a net basis, central banks hold more worth of gold than they do of treasuries at this point in time, foreign central banks.
Yes, yeah.
Yeah. And then your concluding chart here is that, gold is the best indicator of reflation or deflation. This is sort of one of the reasons why I was poking at you earlier to get a sense for whether you thought that things were going to pick up or slow down after this Iranian war. Although you can kind of make an argument, whichever it is, as long as it goes up or down, gold may play a role in or have a positive reaction to that.
Yeah, I think you're right. Like if we had, and I think Ted would be the first one to say if he was sitting here that we don't know what's going to happen. You could have a renewment of the oil price spike where you go even higher than $120, which was the high that was made last month, and that could really drive things down for the overall economy. But to your point, either way, either the oil price really spikes and then you get deflation, and then gold comes out stronger at the end of that on the other side, or if things do calm down from here we kind of go back to what we've been seeing in the last few weeks is these governments that I think this was a part of it. These governments were using the high appreciation in their gold reserves to sell some of it to help provide a bit of ballast to their struggling parts of the economy with a higher oil price. Now, if things are going to go back to a bit more calmer environment, they can get those gold reserves back, which increases the demand for gold, and then we're working our way back to a higher price, and this structural trend we've had continues.
Yeah, and I've been kind of referring that to like a global margin call at the sovereign level, right? Where they're just we got to pay a lot more for oil, so how are we going to afford that? Well, we got this gold that's appreciated a lot. We're going to sell some of that, right? And it's putting it's depressing the price of gold in the process. You're kind of nodding as I'm saying this. On a somewhat related note, I want to pull up one other slide you have here. This is kind of going back to the stock market, but margin debt continues to be at all-time highs here. How much of a worry factor for you is this?
It's always a worry. The thing with margin debt on a stat like this is it's a coincident indicator. It's not a leading indicator. So it's not going to tell you when the high is. It's just at some point it's going to peak when the market peaks. And the real thing to notice with these lines, especially just look at the last three, the ones in 2000, 2007, and 2022, is when they get to that extended of a level and they start to come down, they're going to come down by a lot. And that's where you get a pretty significant bear market because there's just a lot of leverage to unwind. And I think that's what we're seeing in these declines is a lot of the main trading in the stock market today are very similar types of traders that are very momentum oriented, want to take advantage of lower volatility. But when volatility in the market gets high and there's some sort of a concern, whether it's in the economy and the market, there's a lot of money that can leave in a hurry. And so we just always want to make sure we're positioned in a way that when that happens, we're not feeling like we're caught offside and have to really make adjustments. We're already ready for it, and then we can actually think proactively and almost aggressively what few things we want to buy rather than thinking about, oh, we really were mispositioned and we need to find five things to sell right now.
Yeah, and this is why in the majority of your portfolios, Oxbow manages those three primarily. Um, you're at like 40% cash, right? I'm guessing you're at that high a level, not just because of the margin debt, but other valuation factors and other issues where you're just like, it might not be our default prediction for the year, but we just think the risk of that rapid downdraft is uncomfortably high that we're going to keep dry powder on hand. So if indeed it does happen, we can be aggressive in the way you just mentioned.
Yeah, and to your point, you were asking earlier about, outcomes of the war and if things calm down, everyone goes back to the same playbook of the last 3 years. What that also means is we're just going to go back to two major things that we're watching that we can't predict if or when the shoe might drop. But one is AI, which has been such a big driver, and at some point there could be something that the spending in that area starts to fall, and what the ramifications of that could be for what is 40% of the market that is essentially an AI play right now and driving two-thirds of the market return for the last 3 years. So what happens there? And then the other one is what's happening with private credit and if there's any more significant fallout there. And that's one that we're just watching. We really have zero exposure to any of those companies, so we don't have to worry about it in our portfolios. We're more just curious to see if anything happens that leads to sort of a waterfall effect that you could have a broader market impact, which we would then just view as an opportunity to buy more of the companies we want to own at better prices. But you don't know if either of those two things could end up having a bigger negative impact on the market at some point. I would say in the next 2 to 3 years, if you look out at, especially in AI, you look at even bullish analysts' expectations for a company like Micron. They have revenue and earnings turning negative year over year in 2028, 2 years from now, and really turning negative in 29. And that's how these semiconductor cycles work. If that actually played out, there's a lot of stock market damage to occur whenever that starts to be priced in, whether that's a year from now or 2 years from now.
Okay. I just want to note for folks this slide I put up here, which again is from your deck, showing that redemption requests in private credit are, going through the roof right now, and that's no surprise to anybody watching the headlines, right? So you you know, there's lots of potential reasons to be worried. General valuations, as we talked about, margin debt, as we talked about, private equity, which you talked about. We'll talk about in just a minute. But you're saying that concerns about just sort of the Capex spending for the hyperscalers, right? Right. The past year and a half or so, it's been what's been driving the markets and what's largely been driving S&P corporate earnings in total. And the question is just if anything gets in the way of that juggernaut, if it starts to slow or, God forbid, goes in reverse, there's going to have to be a pretty dramatic downward repricing. So I'm summarizing the risk there accurately, correct?
Yeah, absolutely. I was just reading a report this morning that the biggest multiple expansion within industries of the market over the last, say, 3 years have been the capital equipment plays in both semiconductors and industrials. So that could be like Lam Research or KLA or Applied Materials on the semiconductor side that make the equipment for the semiconductor companies.
Mm-hmm.
Or it can be the industrial capital equipment businesses like Caterpillar that have gone from, if you look at a long-term chart of Caterpillar, it normally trades at 15 times earnings. I think it's north of 25 times now. At some point, it doesn't mean it's been a great momentum play. And for anyone with that style who wants to continue to ride that wave for as long as they can, that's fantastic for them. But at some point, that will give out, and you're going to see earnings recede at the same time that the multiple contracts on the stock, and that can be very painful. And so for us, with a 3 to 5 year outlook, not knowing if this run ends in a year or 2 years or 3 years, it's just very difficult for us to want to get real heavily involved in stocks like that unless you had a really good entry point or price. But everyone is so bullish about the opportunity that you're just not seeing that right now. So we're fine with just playing in other parts of the stock market and trying to generate a good return where we can in our strategies and watching that to just see how it plays out because history tells you, you know how it will end. You just don't know when.
Yeah. So basically, you're just sidestepping the froth and saying it could go a lot higher, but the risk isn't worth it for us. So we're going to play in a different sandbox, hopefully a safer sandbox. I just want to note on private credit that Ted Oakley from Oxbow, in your guys' Q2 outlook, mentioned his opinion, which I'm guessing is the firm's opinion as well, that uh, you guys aren't saying that this is another subprime crisis, and I've had a lot of people on saying it's just not, when you look at the size, it's just not nearly as big. Um, but it's some of the problems that we're hearing about in private credit are indicative not just of private credit, but of private equity as well. That in a lot of cases, there's a lot of junk out there in this space. And if we're going through a process of that junk starting to be priced to market, then this is probably likely not over. And in Ted's word, it potentially has a lot further to fall. And again, I don't think you guys are saying this is the conflagration that creates the next great financial crisis, but it sounds like you're saying we think the trend for private credit is going to be down for a good while from here.
Yeah, we think it'll be a struggle. If you just look at, we just focus on private credit. Um, in my career, whenever I hear anybody call something a no-brainer, I can't tell you how often, if not 100% of the time, it ends up not working out.
Yeah.
And I think about that for private credit because I can imagine over the last decade, they were looking at these software businesses they could buy out with very consistent revenue, high operating margins, and just thought it's a no-brainer. We'll buy these, lever them up, run them for a while, and then sell them at a higher multiple. And now that's an outsized portion of their portfolio. And that is the one industry that is the most risk from the growth of AI. And now they're really in trouble because even if the businesses can generate good cash flow, the exit multiples they're going to get trying to sell those businesses, because they will need to sell them at some point, is not going to be what they projected. And so that's one problem. Then you just have the idea of private equity or private credit in general. It tends to be buying sort of average to below average businesses, lever them up, try and extract as much cash as you can, and then sell them at a higher multiple. And there was this mirage of, without any sort of daily volatility that's being priced in, people think that, oh, it's just a great risk return profile. When for some time now, starting over the last, say, 15 years, when there really were high allocations to private equity and then private credit, you can make the case that whether it's private equity, private credit, private REITs, they don't generate any better returns than those asset classes in the public markets. It's just this perception that it's less risky when that's not the case. So I think Ted and I are curious to see how this plays out because will you see any of these pension funds, endowment funds, family offices start to reorient their allocations if the outcomes they were projecting from this part of their portfolio does not play out how they anticipated over the next 10 years?
Yeah. And I'm wondering, in addition to just losses in the private asset portfolios, um, which, folks, those losses take a long time to play out because these are illiquid funds in most cases. Um, and, for a number of the current private credit funds that are under stress, I am delivering the warning, Chase, Chance, that it doesn't mean that these things are going to zero. In fact, time can help these portfolios heal, right? And so, uh, don't necessarily count some of these players out. And there's a lot of kind of big players, the Apollos, the KKRs and stuff of the world who they've really gotten whacked price wise. And they may come out of this okay in the end. I mean, these are the guys who get the best deals. They've got the smartest portfolio managers. They can dictate the terms of a lot of their deals. So they've got some muscle here. Time will tell if that's true or not. But in the here and now, investors in these funds or in these assets have a perceived sense of loss. Oh gosh, I'm really worried about this and I can't get my money out right now. So what's your only option to protect yourself when you can't liquidate the illiquid stuff? Well, you liquidate what is liquid. So I'm just curious, how much concern, if at all, do you guys have for a contagion effect in the public markets? Almost kind of like this margin call with gold and oil at the sovereign level we were talking about, where people are just like, look, I got to de-risk and I can't do it in the private assets, so I'm guessing I'm going to have to do it in the public ones.
Yeah, I don't know that we're trying to predict it, but it's definitely a possible outcome, and we would just view that as an opportunity because that's not our problem. And I think, any
It
investing
just puts
text,
asset on sale for you guys.
yeah, I don't know what any investing textbook you read, or I think I remember Seth Klarman saying it in his book Margin of Safety. Like, there's nothing better than buying from a forced seller.
Hmm.
So if you do have players, and I think Steph Pomboy mentioned it to you on her interview with you recently about this idea that what you're saying, go into the public markets because it's the only place you can go. For a pure public market investor like us, that's great. If you've got people that are being forced out, they need cash for another part of their allocation. And if we see some of the companies that we want to own all of a sudden hit prices that are 15 or 20 or 30 or 40% cheaper, and we still think the cash flows are intact for those businesses, it's just an outside event that's causing the price to get a lot cheaper. That's absolutely something that we would jump on.
Okay. Extra points, by the way, for revealing that you watch additional thoughtful money videos besides the ones that you and Ted appear in. Great job. All right, housing. Um, uh, as you mentioned earlier, interest rates have remained elevated all year, but certainly since the war broke out. Um, Funny in some ways because you normally think there'd be a flight to safety, but that's not really working this time around. Um, and that's probably because of the inflationary concerns that folks have. Um, uh, that means that mortgage rates haven't come down. And we've had this really injured housing market now for far more years than folks expected. Um, what is your outlook on housing and what impact, if any, do you expect that to have on the economy and the markets?
For now, without a recession and a real increase in the unemployment rate, which Ted talks about a lot, is you're not going to really see pain in the housing market until more people, unfortunately, are forced to sell their homes because
Hmm.
if they lose their jobs, they can't pay their mortgages, and it just creates a lot of stress in the economy and for people's lives. If we stay at this current state, I think we just continue to have this sort of weird, sort of semi-frozen housing market, and the rates are really a key issue. And what we watch is the home builders. It surprised us coming off of the market lows in 2022 that the home builders had this huge run
Yeah.
for a couple of years. But if you look at a chart of some of the best run home building stocks, they made their highs 18 months ago, September of 2024, and they just keep making lower highs, lower lows. They keep drifting down. I think it's gotten a lot more difficult for them. They have to continue to provide more incentives. They've tried building smaller houses to keep the price reasonable for people as the rates stay high. They're doing what they can, but I think it's really starting to get more difficult for them. So it's not a space that really allocated to at all. We're just watching, and it's one of those cyclical industries that at some point, if things got really depressed in that market and prices for the stocks that are exposed to that space really fell a lot, I think we would consider jumping in more, especially in the stock portfolio, because it can do well in an upcycle. But for now, just thinking about our portfolio, the only thing we've owned for a long time is a small position in Lowe's, which home improvement retailers are kind of a different part of the business. It's a very stable cash flow business, but to actually get into the housing market, that's when we're just kind of watching and seeing how it plays out.
Okay, yeah, and I'm asking less about housing equities and more about its potential as another, well, whether you think it's
Contagion.
going to be a propellant or a drag on the economy. And I want to pull up another slide from your chart here. And I should have mentioned this earlier, folks. These slides will be available in the Substack write-up to this interview. So you can go get them there. And if you are not yet subscribed to our Substack, you can do so now for free, simply by going to thoughtfulmoney.com/newsletter. And again, it's free to sign up. Um, so here's a chart you guys have of quote unquote paper wealth, which is basically just the simple arithmetic of adding real estate equity and stock equity prices together. And what's notable about this, no huge surprise that they've gone up over time, but it's the multiple to GDP that appears concerning here. So as your chart here says, it is now 26% higher versus GDP than during the 2007 housing bubble and 44% higher than versus the 2000 tech bubble. So this is kind of going back to our concerns about valuation, margin debt, all that type of stuff, right? This is one of those swords of Damocles that's perhaps hanging over the system right now, which is this chart's not a timing indicator, right? We have no idea when this will end, if it will end, um, how big a correction it might be. But you just got to kind of look at that and say, all right, if this just normalizes to historic averages, yeah, there's going to have to be downward pricing both in real estate and stocks. And when you have a repricing in stocks, you have a negative wealth effect, right? But I would argue the negative wealth effect is greater in housing because housing is much more widely owned. It's a much larger portion of the average person's, um, home balance sheet than their equity investments are. So how much does this worry you at Oxbow of this kind of potential sort of Damocles where the thread might break and we got to weather whatever the repercussions of this are going to be.
It's definitely a factor we consider. It's similar to the margin debt one, where it's not necessarily a leading indicator. It's not going to predict when these things are going to peak and go down. but it's one of those amplifiers of a decline that if you actually saw stocks fall 20% or more and stay down, you don't just get this automatic bounce back after a month or two, but really stay down and keep trickling lower, as Ted would talk about, like a true bear market that lasts longer than a year. That's something that you'd really start to see, I think, an effect on consumer spending. And then the housing market, I think,
Then you get that rise in unemployment that then injures the housing market, right? Yeah.
exactly. So I think it could come from either place. I think for housing, it's going to relate more to an actual like economic slowdown, rising unemployment, and puts more stress on people with paying their mortgage. For stocks, it could just be, any number of things that could send stock prices lower, and stays lower and starts to really make people question the value of being that all in on the market, which after 17 years of basically having an up market, it's hard for anyone to see where things can go poorly. And it's going to take time for people's psychology around owning stocks to change to be a little bit more balanced on considering the risks on top of just thinking about how they double their money again.
Hmm. All right. A few more questions and then one big one, and then we'll wrap it up. Um, Oil stocks, energy stocks, and particularly fossil fuel stocks. I believe from previous conversations with you and Ted, near the end of last year, you guys thought, hey, this sector might be looking like it's going to get some life breathed back into it. Totally the case at the beginning of this year, pre-war, ironically. Then the war happened and oil prices went bananas, right? And so that's obviously going to be quite helpful to their immediate bottom line. So Q2 will probably be a pretty good quarter for these guys. As we said, though, the futures market doesn't really expect this to last for super long. So I guess my question for you is what are you guys doing right now with oil stocks? Have they gotten ahead of themselves and it's time to trim and reduce exposure, or do you see a reason to keep positions static or even increase them?
Yeah, I think the thing that maybe gets misunderstood about the energy industry when you're looking at it from a stock perspective is how many sub-industries you can play in.
Hmm.
So our exposure to oil has not changed that much from the beginning of the year. You might think with the oil price having gone up so much, we would have taken a bunch off the table. But more than half of our oil allocation in the high income strategy is pipelines,
So
which
it's more the what they call the midstream companies.
yeah, exactly. So those have done well this year, but in the spike in March, when the oil price went up, I was just looking at enterprise products, which is one of our core
Hmm.
holdings. It was only up about 10% that month. Like it's not, it moves on a different sort of set of variables. Those are long-term contracts that are more volume oriented rather than price oriented. So that's more of a stable base to our oil exposure. And then we weren't necessarily owning like the names that we own might be like oil services companies that could see increased drilling over the next years to come, whether it's in the Americas or in the Middle East, after damage that's happened to the energy infrastructure there. We own a tanker business. We had actually trimmed some of our natural gas positions just because as the oil price went up, you saw weakness in the natural gas price, just because a lot of drillers, especially in the US, kind of have to choose one or the other. So there was an excess of natural gas being produced that was driving down the nat gas price.
Right. Well, and if you rush to drill more, which people think we're going to do because these high oil prices, well, that just releases a lot of byproduct natural gas, adding to the inventory of that market. Yeah.
Exactly. And so that's actually started to revert back to the mean as well, but in the other direction. So like today we were adding a position that we had owned up until a month ago in Antero Resources. And now we're able to buy it back at a cheaper price than where we sold it a month or two ago and get that position back in the books. So that's the sort of adjustments you're making. But I think eh, going back to looking at things out years into the future, even if the oil price comes back down towards the 60 to $70 range later in the year, as if nothing ever happened, we do think we're entering a regime where the oil price on average is going to be higher than what we just experienced over the last, say, 6 or 7 years. That normal price, that's the break-even level that drillers need to be able to turn a profit, that price is going to escalate over time, and it's going to be good for owning energy stocks for the rest of the decade.
Okay. Um, One man's thesis here. You don't have to agree with it, but I think the odds are that whatever the amount of global oil and gas that was shipped through the Persian Gulf before the war was, that percentage is going to be lower of the world's total afterwards. Not because of crimped supply, although that could be the case for a while, but because of just the risk premium that the world woke up and said, you know what, we were treating it like it was riskless. It's a risky place. I'm still going to buy some stuff from there. I'm just going to source more from other places in the world that have less geopolitical risk. And so in America, is probably one of the beneficiaries of that. Certainly seems to be right now with the flow of tankers that can't do business in the Gulf coming here now. So for that midstream sort of sweet spot for you guys, which is volume driven, not so much price driven, do you expect sustained higher volumes going from here? Meaning, is this a sector not only going to continue to own, but maybe might increase exposure to?
We're pretty full in our exposure. I mean, if we weren't full in our exposure, I think we'd be adding to it on
Okay.
pullbacks in those share prices, but it's already probably close to 10% of the high income portfolio. So I don't think we'd want to go much higher than that. We own the names that we want. And it's just, Ted considers almost like owning a piece of real estate where you can get a mid to high single digit dividend yield, a little bit of growth in the earnings over time, and really know that the valuation is always going to be pretty reasonable because it's just such a steady business. You don't see a lot of extreme sentiment in either direction with stocks like that. So it's an easier name to be able to own through a cycle and just kind of depend on that income coming through.
Okay. But to my thesis, let's say for somebody who doesn't have exposure to this space right now and is thinking about it, sounds like you would say, hey, the war is probably just helping this sector going forward.
Yeah, we think it's a positive. The bigger thing for those sorts of businesses was just straightening out their balance sheets and not having so much focused on additional Capex spending. They're really generating a lot of free cash flow now, paying good dividends, and I think the management teams have really become pretty solid in their capital allocation decisions. So I think that, as much as anything, has led to good outcomes in those stocks over the last handful of years.
Okay. Prior to the war, how much of a percent, if any, did defense stocks have in your portfolio? And are you more or less bullish or the same on that sector post-war?
We didn't own any, and we don't own any now, but I think that's just because there already was a premium in those stocks. We've owned them in the past, in previous years when almost like pre-Russia Ukraine,
Okay.
when there was less of a premium on defense, and they tend to not see huge changes in their contracts and their revenue growth, despite this sentiment that if a war breaks out somewhere in the world, I think people think that all of a sudden revenue growth of Lockheed Martin is going to go to 30% year over year, and that's just not how these businesses operate. So you almost need to wait for a sentiment that's more thinking that's just going to be peacetime forever. The multiples come back to more of a, call it a mid-teens level on a price to earnings ratio, and then you're able to buy in at a reasonable price and own it for the earnings growth. And then if you get a bump in the multiple because people perceive, in a war going on, that this business is worth 22 times earnings rather than 15 times, you get an additional appreciation. You can decide then whether you want to take some profits off the table or not.
Okay. All right. I got to squeeze in one more big topic, although we'll just get your concise answers on it, which is bond duration. You guys, don't let me mischaracterize this, but you guys generally are keeping your bond duration, whether it's treasuries or whether it's corporate bonds, 5 years or less.
Correct.
And you
Yeah.
don't think that the risk for going further out than that on the yield curve is worth it. Can you explain why for folks?
Yeah, I think the interest rate cycle, at least if you look back the last 100 plus years, they tend to move in these 30 to 40-year cycles where the rates are either kind of persistently rising or persistently declining. And so you had a stretch from the 1940s to the early 1980s where rates were pretty steadily rising, peaked in the early 1980s, and then you had a period of nearly 40 years where you saw interest rates and inflation decelerating and falling. And we think that in 2020, that was the low of that 30 to 40-year period in the interest rate cycle. And we're now nearly 6 years into an upward movement in interest rates. And if you're in that sort of environment, it really impacts how you want to, what sort of assets you want to allocate to, and the duration of the different assets you want to allocate to. So You really just don't want to get caught owning certain things that are long duration with no upside. So we used to have 10% allocated to regular preferred stocks. Now it's basically zero, just because those move with interest rates. And then to Adam's point, on long-term treasuries, if you're going to have potential for higher interest rates over time, higher inflation, and more volatility, which is equally important in interest rates and inflation. Really not the best to own a 20 or 30-year bond in something just because you don't have any idea what the inflation rate is going to turn out to be, and you might end up not really protecting your purchasing power over that long of a time period. Ted, just one last point. Ted pointed out in that call that he did at the beginning of April that if you can get a 2-year treasury for just under a 4% yield, and you've got a 20 or 30-year that's still below 5%, like it's really not worth just getting
Right.
an extra 1% in annual return with all of the risk that comes with that. Better off just trying to continue to lock in these more or less 4% yields while they're there. And then you might look up in 5 years and we're sitting at a 5 or 6% yield. And the world looks a little bit different. And then you can adjust accordingly rather than being locked into these really long-term bonds.
Okay. Thank you. Very well put concisely. Okay. So last big question. Uh, Oxbow is as I said in the intro, it's a high net worth advisory firm. I will be transparent as I always am when you guys are on, let folks know that I am a client of Oxbow. Now, that being said, Ted did me a big solid a few years ago and let me kind of scoot in the back door because I didn't meet your minimums. But Oxbow's bread and butter is dealing with high net worth families and addressing their needs because they oftentimes have a unique set of needs beyond just the average investor, and obviously helping grow and protect their wealth after that. Can you just talk, because I think there's a lot that the average investor can learn from what the high net worth investor does. And of course, pretty much every average investor is aspiring one day to hopefully become a high net worth investor. Um, can you talk about Oxbow's philosophy and approach? I should also note too that big part of your bread and butter as well is not just high net worth people. It is, but in particular, you specialize in people that have had or are about to have a big liquidity event, oftentimes a life-changing one. This could be an entrepreneur who ran his business for decades and then sold it and is now sitting on a big pile of cash, but they're not really, financial money management isn't their skill set. And also their kind of reason for getting up in the morning is gone and they're trying to figure out who they are. Similarly, it might be somebody who worked for a company that ended up going through, a hyper growth phase, and all of a sudden their stock options are worth a ton of money they weren't expecting, or just somebody who's inherited a bunch of money. And this could be, your rich uncle dies, but probably more commonly, I'm guessing, it's your spouse dies, and they were the ones that were managing money, and all of a sudden you realize, okay, that's a lot of money that's now I'm responsible for, but I don't have the expertise for doing it. So with all that context in mind, can you just talk about sort of Oxbow's philosophy and approach to investing?
Sure. I think and Ted's dealt with so many ultra high net worth or high net worth individuals and watched the good ones versus the ones who didn't do so well, trying to manage that wealth and
Right.
really
Meaning
seen.
made a lot of mistakes after they came into that money, right? Yeah.
Yeah, yeah, all too common, unfortunately. But I think the people you see really manage this well. First, if you do have a liquidity event like that, it's really just don't be in such a rush to try and put it to work. You might get all sorts of people really interested in trying to help you do something with that money. But our advice has always been you want to wait a year or even 2 years before you really try to do anything significant. Because as Adam just said, it's really a major life event that you have to process what your day to day is like, what your relationships are like with people close to you, what your role is in life, what you're doing with your time. And you don't have to go out and figure out how to put $10 million to work the next day. It'll still be there. You'll be in a better frame of mind after things are more settled.
Hmm.
So that's the first thing is just I don't think to be in any rush. And then the second part is I think we see people at that level really have a lot of balance. And so like when Ted will put up these charts that show that people in their 401ks, people who are at a retirement level in their 60s or 70s or even 80s that have 75 or 80% of their financial capital in stocks. That's not what you see with these high net worth individuals. There's a lot more balance across asset classes. So Adam mentioned that 30, 30, 30, 10. That's not an exact ratio that we split to, but I think that's something that talking about this change in interest rate regime, that's the sort of allocation to think about where you've got a portion in stocks, you got a portion in short-term fixed income, you've got a portion that's exposed to commodities and what's going to likely be a higher inflation regime in the years to come. And then you got a little bit left over, whether that's in cash or special situations, things like that. But I think that's the sort of thing where you've got the short-term fixed income as a base that you know is going to be able to really not suffer any losses. And then you try and use the commodity and equity portions to try to continue to maintain and potentially increase your purchasing power. But you don't have to go out and seek 20 and 30% annual returns like you're going
Hmm.
to be the next Warren Buffett. You've already won if you're at that level. And it's more about just making sure that you've got things set up in a diversified way that regardless of what happens in the world, you're going to be okay. Whether it's a high inflation regime or a deflationary recession, you got something that's going to be working in your portfolio that's going to allow you to be able to withstand that and then continue to grow it during more normal times.
All right. And just help folks understand sort of what the intake is like in the sense of we talked about Oxbow kind of, I mean, you customize everything obviously to the needs of the client. But your job as the CIO on a day-to-day basis is first and foremost to manage the portfolios of your key model portfolio as well. And then you kind of help people build their own personal allocation based off of that. Okay, we'll put you 25% in this one and 15% in this one and whatever in this one. And then we'll do some custom stuff because of your unique personal situation. Remind them what those three portfolios are.
Sure. So we have three strategies. We have conservative fixed income, which is really just the base capital that's meant to just not lose money. That's primarily short-term treasuries and municipal bonds, a little bit of gold, just as another way to try to maintain or grow purchasing power. The second portfolio is high income, which is just meant to generate good income and beat what you'd get in the bond market. And that's the one that's a mix of high quality fixed income that's shorter term oriented and then commodity-based businesses and still trying to generate a mid-single digit dividend or coupon yield for you to have income coming through. And then the third strategy is our long-term growth stock portfolio that's meant more for asset appreciation. So it's less about the dividends you're receiving, but more about owning a really high-quality collection of businesses at good prices that you think can generate a double-digit return over time. And that's more of the growth piece of the portfolio that you're trying to just put money in there and really not need to touch it for 7 or 10 years or longer so that you can let the appreciation of those businesses happen on its own.
All right. Well, Chance, Ted often lauds you, praises you, and says you're the best in the business, which is why I hired you to be the CIO there at Oxbow. As a client, I haven't seen anything there to make me dispute that. So kudos to you. All right. So for folks that are thinking, hey, I might want to talk to Chance and Ted and the team there at Oxbow. First and foremost, to do that, they should just fill out the very short form at thoughtfulmoney.com/Oxbow. And folks, that link's right below the video here too in the description. But I just want to make sure we're not setting folks up for disappointment. I know you guys at Oxbow are extremely generous in helping anybody, and this is one of the reasons why Ted publishes so many books that you guys give away for free. But in terms of being able to work with you, you do have your minimums. As I mentioned, you guys are a high net worth advisory firm. What threshold should we just tell people here to just, I don't want to set up anybody for disappointment if they contact you with $500,000 or less and you guys say, oh, I'm sorry, we can't work with you. What threshold do you want me to put out there to just say, hey, if you're reaching out to Oxbow, they'll do their best to answer your questions, but they might not be able to take you on as a client yet because you don't have enough assets?
Yeah, I mean, we're always willing to talk to people. I think Ted always talks about that, ultimately our goal and our reason for being here is just trying to help people and feel better about their financial situation. But in terms of actually managing money as a client, it's over 2 million for us to be able to do that here in-house.
Okay. All right, folks. So again, if you want to talk to the folks there at Oxbow, and again, this is totally free, just go to thoughtfulmoney.com/Oxbow. Fill out the short form there. Only takes you a couple seconds. Again, these are totally free. There's no commitments involved. It's just something that the guys at Oxbow do to be as helpful as possible. And if you just want to talk to them, you can do that too, as Chance said. They just might not be able to take you on as a client. All right, folks. Well, look, Chance, this has been another fantastic discussion. Very much appreciate you coming on, and you're just kind of a by the numbers kind of guy. Ask a question, you give concise, direct, digestible answers. I really love it when you come on. So folks, please help me thank Chance by clicking the like button and then hitting the subscribe button as well as that bell icon right next to it. If you notice, folks, we just passed 170,000 subscribers to this channel. It's awesome. Thank you so much for all that support. We're trying to get to 200,000 as fast as we can because it really does help YouTube give this channel even more support. So if you haven't actually hit that subscribe button or click that little bell icon, please do so now. Can't thank you enough, Chance. Any parting bits of advice you'd like to give the viewers just in terms of navigating and maybe more importantly, just sort of staying sane in this high uncertainty environment that we find ourselves in?
I think Ted put it well in his quarterly video that he put out last week to just stay flexible. Even though it seems like we just went through this kind of volatile short-term correction and now we're back to new all-time highs in stocks. It still may be an up and down rest of the year, and just to be prepared for that and stay balanced, stay flexible.
All right. Guess those are just words to live by in any market, but especially true now. Chance, can't thank you enough. Really appreciate it, my friend. Hope to see you back on here soon.
Yeah, definitely. Thanks, Adam.
All right. And everybody else, thanks so much for watching.